So what are some of the pros and cons when working in equities? The first one is that you get to regularly meet and interact with management teams of the companies you cover. For example, let's say you're covering the tech sector as an analyst, or you're investing in the tech sector as a portfolio manager. You'll be running meetings with senior executives from companies such as Apple, Microsoft, Facebook, and so on. Larger firms also, they get direct access to CEOs and CFOs. So imagine hosting a one-on-one meeting with Apple CEO Tim Cook. Could definitely be very exciting. They get to travel a lot and do on-site tours, meet with clients, meet with other analysts, and so forth. So I already gave you one example earlier when I was working in Fidelity and I was doing tours of oil drilling and shale fracking sites in Texas. Once I also did a tour of Tesla's new Gigafactory because I was analyzing renewable energy and battery storage. So it's very interesting work. There's no limit to creativity while doing your research, and usually you have a lot of work on autonomy. So, if you think about the creativity that these analysts do in terms of their workflow, so healthcare analysts, for example, they can be talking to doctors to assess the potential of a new drug. Auto analysts, they could be test driving Tesla's latest model to see how good it is. An energy analyst might look at satellite imagery to see how much oil is in storage. So there's a lot of ways you can creatively do your research. You also have a lot of work autonomy, and by that we mean you can go about deciding how you want to research, model, and value a company. Then you can break into equity associate roles, so these are the more junior ones, from different educational and work backgrounds. Equity departments often hire graduates who studied non-finance subjects, such as engineering, life sciences, philosophy, and so on. Equity teams, they want to hire smart and creative people at the end of the day, and technical skills such as reading financial statements and valuation, that can be taught on the job or through external programs such as the CFA. Also, technical sectors benefit by hiring professionals who have actually worked in that sector. For example, take an equity team focused on the healthcare sector. They would benefit from hiring a trained medical professional because that professional can make sense of new pharmaceutical products, assess the success potential of a clinical trial, and so forth. Last but not least, and we touched on this a little bit, the nature of the work is quite interesting. Working in equities means you get to learn how various businesses and industries function. So how does Amazon run its warehouses so efficiently? How does the utility sector generate electricity and transport it to people's homes? How does fracking for shale oil work? This is the kind of things you learn about when you work in equities. So what are some of the cons? Sometimes you have little say on which sector or region you'll cover. Especially if you join a team as a junior, you could be assigned a sector you don't particularly enjoy or find interesting. Now, does that mean you're stuck with a sector forever? The answer is no. If you prove yourself and add value in the sector you're given, you can always request to switch, and your director of research will most likely honor that in order to retain you. Also, some firms have sector rotations. So every 2 to 3 years, they make the analyst rotate to a different sector. Now, if you cannot change sectors, but you really enjoy the one you're given, just note that you run the risk of becoming too much of a specialist in a particular sector with little knowledge of what's happening in other sectors or how to analyze them. That's fine if you want to be a career analyst, that is, spending all your career looking at one particular sector. But it's not ideal if you want to be a portfolio manager, because if you want to be a portfolio manager, you need to be able to analyze and invest in many different sectors. So that's something worth bearing in mind. One other con is that the workload during earnings season and conference season can be quite long and tedious. Earnings season takes place over 2 to 3 weeks per quarter, and it's a busy time because you have to update all your models and issue new reports with new estimates. Industry conferences are busy periods because you run around meeting people all throughout the day, and then you have to do your actual work in the evening. One other con is the sell-side equity research is on the decline. This is due to the reasons we mentioned earlier when talking about key trends and their impacts, namely regulation and MiFID II. It's worth bearing in mind that sell-side equity research is declining, but it won't disappear as it still serves an important function for both investment banks who provide it and the investment teams who consume it. Sell-side analysts can sometimes be a bit pressured on what ratings they assign to certain stocks. This is especially true if you're working for a sell-side department that's part of a wider investment bank. In that scenario, you might feel pressure to assign favorable ratings on companies that are the investment bank's clients. Lastly, equity trading is less exciting relative to other asset classes. Equity trading, especially in single stocks, has largely been automated on the sell side. On the buy side, equity traders are mainly executing portfolio managers' orders by entering them in their systems. Now contrast that with a fixed income trader who has to constantly stay on top of fast-moving bond market conditions, liquidity, and trends. They have to actively search for buyers or sellers in specific bonds by calling various brokers and banks and so on. It's a lot more exciting than equity trading, where you're mainly entering trades in a system.